Hi, my name is Shari. Today we want to present about the Sunway Berhad structural equity analysis. This is our group members.
Hello everybody, my name is Sharvina Udayan. My metric number is HFT20303, and today I'm going to share a short introduction about Sunway Berhad regarding my financial management assessment. Sunway was founded in 1974 and started as a small time mining company. Over the years, it has grown into one of the Malaysia leading corporations, operating more than 50 locations, and the employment is over 11,000. What makes Sunway special is its wide range of business, including property development, healthcare, construction, hospitality, and other. Because of this diversification, the company is able to stay strong even during economic challenges. Another key strength of Sunway is build, own, operate concept. This means the company not only build township but also manage and develop them into complete communities where people can live, work, and study. And the best example is Sunway in Kuala Lumpur. And besides business success, Sunway also focus strongly on sustainability and social responsibility by supporting the United Nations Sustainable Development Goals. In conclusion, Sunway Berhad is not only a successful corporation, but also a company that aims to create a better and more sustainable future for society. Thank you.
This slide shows the 4-pillar structure integrity matrix, which evaluates Sunway Berhad financial performance based on profitability, efficiency, liquidity, and solvency. Firstly, profitability improved from 9.34% to 50.50%, showing stronger profit generation. Secondly, efficiency increased from 1.12 times to 1.82 times, meaning the company used its assets more effectively. However, liquidity slightly declined as net working capital decreased over the years. Lastly, debt to equity increased from 0.24 times to 1.29 times, showing higher dependence on debt financing. Overall, Sunway showed improving performance and growth, but financial risks from rising debt must be monitored carefully.
This slide presents the company profitability and efficiency ratio from 2021 to 2025. Net profit margin up from 9.34% in 2021 to 15.50% in 2025. Return on asset up from 1.31% in 2021 to 3.66% in 2025. Return on equity up from 2.95% in 2021 to 8.95% in 2025. Inventory turnover up from 1.12 times in 2021 to 1.82 times in 2025. The operational engine accelerating margin and faster inventory conversion indicate highly effective cost management and a robust sales recovery across major business sectors.
Assalamualaikum and hi, my name is Norashima binti Ibn Hashim. My metric number is H24A2904. This is my part, which is net working capital, current ratio, and cash ratio. First, the net working capital show fluctuation between 2021 and 2025. In 2024, the company achieved the higher volume, which is 2.88 million, which is indeed a strong working capital position. However, in 2025, the amount carried to RM 1.06 million, showing a reduction in short-term financial flexible. Next, the current ratio declined from 1 to 8 in 21 to 1.7 in 25. Although the ratio is still above the danger line of 1.0, the downward trend suggests that the company needs a strict monitor of the short-term profitability and liquidity management. Lastly, the cash ratio increased slightly from 0.42 to 0.46. This indicates that Sunway has improved its ability to use available cash and cover liability. Overall, Sunway still managed positive liquidity performance, but the company should closely monitor in cash conversion cycle to ensure stable cash flow and stronger financial stable in the future. That's all. Thank you.
This slide shows Sunway financial position based on the Z-score barometer. The company recorded a Z-score of 1.16, which places it in the grey zone. This means the company is not in a completely safe financial position and may face some financial risk in the future. Looking at the financial ratio, the debt-to-equity ratio increased significantly from 0.24 times in 2021 to 1.29 times in 2025. This indicates that Sunway is relying more on debt financing compared to shareholder equity. In addition, the debt-to-asset ratio increased from 31% to 56% between 2021 and 2025. This means that a largest portion of the company's asset is financed through debt. Overall, although Sunway continues to expand its operational and generate profit, the increasing debt level have raised its financial risk. Therefore, the company is currently positioned in the grey zone and should manage its debt carefully to avoid financial risks in the future.
Hi, my name is Vivian Koliting. My metric number is H24A3210. My part is integrated equity dashboard. So, in 2025, Basling revenue is RM 9.81 billion based on tourism recoveries. Second is poverty aspiration, and third is healthcare demand. So, our effect to foreign third growth rate is 10%. So, in 2026, foreign third sale is RM 10.79 billion. That's all from me. Thank you.
Assalamualaikum to Dr. Yusuf. This slide shows the revenue to profit waterfall chart, which explains how the company's projected revenue is transformed into net profit. The company is expected to generate RM 10.7 billion in revenue. From this amount, RM 8.23 billion or 76.29% is spent on the cost of revenue, leaving a gross profit of RM 2.55 billion. Next, administrative and other expenses of RM 1.58 billion are deducted. However, the company gains other income of RM 783 million, which help improve profitability. The company also incurs financing costs of RM 444 billion and tax expenses of RM 369 million. After deducting all these costs, the company is projected to achieve a net profit of RM 1.17 billion. The key message from this chart is that although financial and operating costs are significant, strong revenue growth allow company to remain profitable as long as costs stay proportionate to revenue. The company can continue to sustain its profitability. Thank you.
Assalamualaikum and hi, my name is Nurul Atira binti Amar. My student ID H24A2287. This slide highlights the company's future forecast through two perspectives, which are the forecast momentum and the macro headwinds. First, under the forecast momentum, the company has several strengths that support future growth. The diversified business structure helps reduce dependence on only one sector, which means if one sector performs weakly, other sectors can still support revenue. Besides that, improving cash inflows from higher sales volume shows that the company is generating stronger operating cash. The company also benefits from robust property demands, especially from ongoing demand in the real estate and development market. However, the company also faces several micro headwinds or external economic challenges. Rising inflation increases operating costs such as labor, utilities, and raw materials. Currency depreciation also raises the cost of imported construction materials and supplies. In addition, higher interest rates increases the burden of the company's existing debt because the financing and loans repayment become more expensive. Overall, the Horizon verdict concludes that the company's growth targets are still achievable, but success depends heavily on how efficiently the company manages its operation and control rising costs, especially debt servicing costs and construction material expenses.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Shazlin Alia binti Shahrudin and my metric number is H24A3406. Today I would like to present my slide, which is Integrate Equity Dashboards. This slide illustrates the conflict between the company growth expectation and its actual financial condition, which can create strong incentive for earning management. On the left side, the company is expected to achieve an aggressive growth mandate, include 10% increase in revenue and the maintenance of strong profit margins. These targets are set to satisfy investors and demonstrate continuous business growth. However, the reality shown on the right side highlights significant financial challenge. The company relies heavily on debt financing, as reflected by its debt-to-equity ratio on 1.29 times, while its Z-score of 1.16 places in the gray zone, indicating potential financial valuable when management is expected to deliver strong financial performance despite facing underlying financial difficulties. Considerable pressure is created to meet market expectations. This situation may tempt executives to engage in earning management or creative accounting practices in order to present more favorable financial position than the company actually has. Therefore, the dashboard demonstrates how a combination of high leverage financial strength and ambitious growth target can increase the risk of financial reporting manipulation. To prevent this, the company must maintain strong corporate governance, ethical decision making, and transparent financial reporting to ensure the reliability of information provided to stakeholders and investors. That's all for me. Thank you.
Hi, my name is Zahira Afina Putri binti Syariah Anwar. My matrix number is H24A3156. On this slide, we can see the importance of transparent financial reporting, which act as the foundation of investor trust and sustainable business growth. The building structure represents Sunway Berhad's commitment to accurate financial reporting that is aligned with the United Nations Sustainable Development Goals. When financial information is reported honestly and transparently, investors can make better decisions and assess risk more accurately. However, the three red weights hanging below the structure illustrate practices that can weaken the integrity of financial reporting. Weight 1. Pulling forward revenue refers to recognizing revenue too early in order to achieve short-term targets such as a 10% growth goal. While this may improve reported performance temporarily, it does not reflect the company's actual financial position. Weight 2. Hiding expenses occurs when operating costs are capitalized or delayed to make profit margins appear stronger than they really are. This can mislead stakeholders about the company's true profitability. Weight 3. Masking leverage involves using off-balance sheet liabilities or similar techniques to make the company appear less in debt than it actually is. This can create a misleading picture of financial stability. Together, these practices place pressure on the foundation of transparent reporting and can damage investor confidence if discovered. The key message of this slide is that ethical and accurate financial reporting is not just a regulatory requirement, it is essential for maintaining trust, ensuring long-term sustainability, and preventing corporate failures. As highlighted at the bottom of the slide, values-based education emphasizes that honest financial representation is a critical safeguard against serious corporate risks. That's all from me. Thank you.
Hi everyone, based on our analysis, Sunway Berhad shows both positive and negative financial performance. First, the company has strong business growth and is still able to generate profit. This shows that Sunway's operations are effective and the company has good business potential. However, the company also relies heavily on debt financing. About 56% of its assets are financed by liabilities, which may increase financial risk in the future. Besides that, the Altman Z score indicates that the company is in the gray or distress zone. This means Sunway needs to improve its financial stability and manage its debt more carefully. Overall, Sunway Berhad still has strong potential for future growth, but the company should focus on improving cash flow, reduce debt, and maintaining transparent financial reporting. Thank you.